Welcome back, everyone. I am absolutely thrilled to have you here for another explainer. Today, we're putting on our sell-side equity analyst hats. Our mission, we are going to completely strip away the daily market noise, completely ignore the breaking headlines, and really lock in on the rigorous, fundamental data to find the true intrinsic value of First Financial Bankshares, or FFIN for short. We're going to build a comprehensive valuation case file, block by block, using pure financial metrics. Right out of the gate, we're looking at FFIN's last closing price, which sits at $32.22. But as fundamental analysts, our immediate question has to be, does this number actually represent the real, underlying intrinsic value of the business? Or is it just a reflection of the market's current mood? Well, to answer that, we've got to look under the hood. Okay, let's dive into this. Here is our roadmap for the valuation process today. 1. The equity analyst's mandate. 2. Absolute valuation, cash, and dividends. 3. Navigating missing valuation data. 4. Relative and asset-based models. And finally, number 5, the final valuation verdict. Starting off with Section 1, the equity analyst's mandate, stripping away the noise to find intrinsic value. Now, as analysts, our golden rule, our primary goal, is to model FFIN strictly on its reported financial metrics. We're looking for reality, not speculation. But reality, it turns out, is actually kind of messy here. See, if we value the company based purely on free cash flow, the fair value hits $43.20. But if we base it on traditional earnings per share, it plummets to $28.89. This massive gap sets up our entire mission for today. We need to dig deep into the absolute valuation models to figure out exactly why cash and earnings are telling us completely different stories about this bank. Moving right along to Section 2, absolute valuation, cash and dividends, discounted cash flow, and dividend discount models. Now, what's really interesting about this data is the sheer cash generation. Over the trailing 12 months, FFN generated a whopping $286 million in free cash flow. I mean, that raw cash generation is the exact engine pushing that discounted cash flow target all the way up to $43.20. We're looking at a super healthy free cash flow yield of 6.20% as our baseline for unlevered free cash flows. And when you factor in a return on equity of 13.92%, you can see this is a highly, highly efficient profit engine. 15. That is how many consecutive years FFIN has hiked its dividend. Let me tell you, that kind of consistency is an analyst's absolute dream. When you pair that incredible track record with a 5-year compound annual growth rate of nearly 8% on those dividends, it perfectly validates our choice to use a multi-stage dividend discount model to forecast out their sustainable growth. Which brings us to Section 3, navigating missing valuation data, addressing the gaps in our dashboard. Any honest analyst will tell you you almost never get a perfectly clean data set. You hit roadblocks, and when you do, you have to make clearly stated, reasonable assumptions. For example, our source data lacks distinct business segment breakdowns. So we have to bypass a sum of the parts valuation entirely and just treat FSEIN as one unified operating entity. We are also missing raw debt schedules. Now, normally, that kills an adjusted present value model right in its tracks. But here is the analytical pivot. FSEIN has this ultra-low debt-to-equity ratio of just 0.05. Because their capital structure is incredibly stable and so heavily equity-weighted, the tax shields from debt are basically negligible, so we can safely just rely on a standard DCF instead. Finally, without an unlevered beta to calculate the weighted average cost of capital, we're just applying a sensible standard 8 to 10% cost of equity as our baseline. And this brilliantly illustrates why having multiple valuation models is absolutely crucial, because when standard DCF inputs get a little noisy, we can turn to the residual income model. Remember that 13.92% return on equity we saw earlier? What that means is FK Finance generates roughly 14 cents or pure profit for every single dollar of equity it holds. Because the residual income model builds off the current book value and projects future earnings minus an equity charge, FK Finance's robust ROE makes this a highly reliable valuation tool for us. It lets us sidestep some of the trickier assumptions required in those standard cash flow models. All right, Section 4, relative and asset-based models, pricing FFIN against its history and balance sheet. So far, we've focused on absolute intrinsic value, basically what the company is inherently worth in a total vacuum. Now, we need to evaluate how the market is actually pricing FFIN right now. Typically, we'd run a peer comparison here, finding comparable regional banks. But since our source data lacks an explicit peer group, picking competitors would mean making a massive external assumption. Instead, we can reliably compare FFIN to its own historical baseline. Right now, FFIN's trailing price-to-earnings ratio is 17.14. Historically speaking, that's a real discount. It's sitting well below its 3-year average of 20.13, and it's nearly 20% below its 5-year average.
Next up, we look at the balance sheet itself, through net asset value, or NAV. Simply put, this represents the total estimated value of a firm's assets minus its outstanding liabilities. In fundamental banking analysis, this is essentially your book value per share. Think of it as our baseline liquidation value, like an estimate of the net cash proceeds you'd get if you shut the doors, sold off literally every asset today, and paid out all the liabilities.
So the crucial point here is this number, 2.37. That is FFIN's price-to-book ratio. What this means is the market is currently paying more than double the raw net asset liquidation value of the bank. Now, you might be wondering why on earth pay that premium? Well, because you don't pay a premium for stagnant assets that just sit there. The market is happily paying that multiple because FFIN is operating with incredibly strong 30.56% net profit margins. They are doing exceptionally profitable things with those underlying assets.
Let's move to our final section and see how this all builds together. Section 5. The final valuation verdict, synthesizing the models into a final decision.
We've run all the numbers through our absolute DCF and DDM models, we've verified them with residual income, and we cross-referenced everything with relative multiples and asset values. And guys, here is the ultimate conflict synthesized from our data. If your investment thesis hinges on pure free cash flow generation, and hey, at $286 million over the trailing 12 months, that's a pretty strong thesis. FFIN offers a highly attractive 25% margin of safety at its current price. It's totally undervalued. But actually, scratch that. If you rely on standard earnings per share to dictate your fair value, the current price represents an 11% premium, meaning it's technically overvalued by that metric. Which leaves us with this final, absolutely vital question to weigh. With a margin of safety at negative 11.54% based on traditional EPS, but backed by a rock-solid 15-year dividend growth history and phenomenal free cash flow, is FFIN a high-quality premium bank entirely worth its current price tag? Or is it an overvalued trap trading at double its book value? That right there is the fascinating puzzle of fundamental valuation. I really hope this deep dive inspires you to take these same institutional analyst techniques and apply them to the stocks in your own portfolio. Keep stripping away the noise, keep seeking that intrinsic value, and I will see you on the next explainer.